When you turn 65 in Canada, something really important happens with your taxes that many retirees overlook. There are 4 specific tax breaks that generally become available to you at this age. And I'm talking about legitimate CRA-approved strategies that may help reduce taxes by thousands of dollars over time, depending upon your situation. But here's the problem. If you don't know they exist, you won't understand how to apply them and how that impacts your income planning. Every year you wait, that could mean missing opportunities you may not be able to recover. Hi, I'm Stefano Francesca, Certified Financial Planner Professional and Senior Wealth Advisor at Next Step Wealth Management with IPC Securities Corporation. In today's video, I'm going to walk you through the 4 major tax breaks that become available to Canadians specifically when they reach age 65, and more importantly, where people mess this up and leave money on the table. If you find this helpful, don't forget to like, comment, and subscribe. It really helps more Canadians see this. Tax break number 1, the federal age amount tax credit. The first tax break is the age amount, and it's non-refundable tax credit that you become eligible for in the year that you turn 65. For 2026, the federal age amount is $9,208. That's a tax credit, not a deduction. So at the 14% federal rate, it's worth about $1,289 on tax savings per year indexed to inflation. On top of that, here in Alberta, there's a provincial age amount of $6,345, which provides another $508 savings at the 8% provincial rate. Combined, you're looking at roughly $1,797 in annual tax relief just for being age 65 in Alberta. The provincial amounts are different across Canada, so be sure to understand how those work for where you live. But here's the catch. It's income tested. On a federal basis, if your net income is below $46,432, you get the full credit. As your income rises above that, the credit gets reduced by 15% for every dollar above the threshold. Once you hit $107,819, the age amount is completely eliminated. And here's where planning comes in. If you're married and one of you has little to no income, you can transfer the unused portion of the age amount to your spouse, regardless of their age. And this, of course, has a major impact on how you're going to plan income. Now, some of you might be thinking this is already handled when you file, and it should be. But here's what gets missed. Are you structuring your income throughout the year to maximize the credit? Because if you're triggering unnecessary RRIF withdrawals or realizing capital gains that push you over the threshold, or have a spouse with significantly less income and you've done nothing about that, you're losing hundreds of dollars in age amount credits every single year. And that requires proactive planning throughout the year, not reactive adjustments after the fact. Let me be clear. If you turned 65 3 years ago and you've been missing even $1,000 a year in age amount credits because your income wasn't structured properly, that's $3,000 in unnecessary taxes you've already paid. And there's no going back to fix that. Tax break number 2, pension income splitting. The second major tax break at 65 is pension income splitting. And this is where strategic planning truly matters. Before age 65, pension income splitting is limited. You can split income from a registered pension plan, but you can't split RRIF income. That changes the day you turn 65. Once you're 65, you can split up to 50% of your RRIF withdrawals with your spouse or common law partner. Why does this matter? Because if one spouse is in a higher tax bracket and the other is in a lower bracket, splitting income moves some of that income from the higher bracket to the lower bracket, which reduces your overall household tax bill. And critically, pension income splitting can help you avoid or reduce OAS clawbacks. In 2026, if your net income exceeds $95,323, your OAS starts getting clawed back at 15%. If you're splitting pension income properly, you can keep the higher income spouse below that threshold and protect your OAS. To claim pension income splitting, you and your spouse need to file Form T1032 with your tax returns each year. It's not automatic. Here's the problem I see consistently. Couples know about pension income splitting, but they're not coordinating it with their RRIF withdrawals. They take out whatever the minimum is or whatever they need for spending without thinking about how that impacts their tax brackets, the age amount, and OAS clawbacks. That's the difference between filing taxes and tax planning. Filing captures what you did last year. Planning structures your income throughout the year, minimizing the total tax that you pay. If you're within a few years of turning 65 and you want to make sure your retirement income is structured properly from day one, click the link in the description to book a consultation. This type of planning is included in our Next Step Wealth Management service because maximizing these credits requires proactive income structuring throughout the year, not reactive adjustments after the fact. Tax break number 3, the pension income amount credit. The third tax break is the pension income amount, a federal non-refundable tax credit worth up to $2,000 per year. At the 14% federal rate, that's about $280 in tax savings annually, plus provincial savings on top of that. Again, different for each province. Before you turn 65, only income from a registered pension plan qualifies for this credit. But at 65, RRIF withdrawals become eligible. So even if you don't need the income, in some cases, it may make sense to convert part of a RSP into a RRIF and take a minimum withdrawal of $2,000 just to unlock the credit. And if you're married, you and your spouse, can each claim the pension income amount on your own eligible pension income. So that's $560 in combined federal tax savings each year, plus provincial tax savings. Be careful with this credit, however. I've heard some say that taking out $2,000 of eligible pension income will result in zero net tax, but that's not entirely true. In very low income situations, it's true. With modest income, depending upon your province, it's mostly true. With good income, you're going to pay some tax on that income leakage. Our plans can isolate this tax leakage strategy and determine if it's beneficial for each year of a plan. So don't just follow blindly and start leaking RRIF income without doing some in-depth planning for your personal situation. Here's where this ties back to pension income splitting. If one spouse has all the RRIF income and the other has none, and you don't split it, only one of you gets the pension income amount. But if you split that income, now both spouses have eligible pension income, which means both can claim the credit. You've just doubled the value. This is the kind of coordination that doesn't happen automatically. We gain access to all our clients' tax returns as part of our planning process, and I've reviewed returns for new clients who've crossed that 65 threshold, and they're either not converting to a RRIF early enough to get the credit, or they're not splitting income properly to maximize it for both spouses. That represents $560 per year in potential tax savings that could be going unclaimed. Tax break number 4, provincial age amount and senior credits. The fourth tax break is the collection of provincial credits and benefits that become available when you turn 65. In Alberta, that's the Alberta age amount I mentioned earlier, $6,345, worth about $508 in provincial tax savings at the 8% rate, assuming your income is below the clawback threshold. Just like the federal version, this credit is income tested. And again, this is where income structuring matters. If you're sitting just above the threshold because of poorly timed RRIF withdrawals or capital gains, you're losing both federal and provincial age amount credits. Beyond the age amount, Alberta also has programs like the Alberta Seniors Benefit for low-income seniors 65 and older. These are often smaller and heavily income tested, but they're still worth knowing about and claiming if you're eligible. So here are the 4 tax breaks you get after age 65. First, the federal age amount, worth around $1,289 federally, plus provincial amounts that bring it to around $1,797 in combined annual savings in Alberta. Second, pension income splitting, the ability to split RRIF income with your spouse, which can save your household significant tax and help keep your OAS. Third, the pension income amount, a $2,000 credit on eligible pension income that becomes accessible at 65 for RRIF income. And fourth, provincial age credits and benefits. Now here's what I need you to understand. These aren't just credits you claim on your tax return. They require strategic income planning throughout the year. You need to know how much to withdraw from your RRIF, when to convert your RSP, how to split income between spouses, and how to coordinate all of this to avoid OAS clawbacks and maximize the age amount where possible and appropriate. And here's the reality I see with many retirees. Without proactive planning, they may be paying more tax than necessary each year. I often hear, but I file my taxes each year. Aren't I already claiming these credits? And you may be, but filing captures what happened last year. It's an exercise in tax compliance. Proactive tax planning, on the other hand, means structuring your income throughout the year to maximize these credits before the tax year closes. That's the difference between reactive tax filing and strategic tax planning. Let me put this into perspective. If you're 65 right now and missing just $2,000 per year because your income isn't structured properly, between lost age amount credits, missed pension splitting opportunities, and OAS clawbacks, over a 25-year retirement, that's $50,000. If you're a couple and both of you are affected, that number could double. So the question isn't whether you should plan for this. The question is, how much longer are you willing to wait before you do something about it? The difference between retirees who pay the minimum tax legally required and those who overpay isn't luck, it's planning. It's having someone who reviews your situation every single year before the tax year closes and makes sure your income is structured to maximize every credit, every deduction, and every dollar you're entitled to keep. If you're a Canadian retiree within 5 to 10 years of retirement and you're wondering if you're paying more tax than necessary, Click the link in the description to book a consultation. Our Next Step Wealth Management service integrates all aspects of your financial life into a well-thought-out plan. We'll walk through your specific situation, look at your income sources, structure your investments effectively, and show you exactly where you may be leaving money on the table. And more importantly, how to fix it before the next tax year closes. Because here's the reality. You can watch this video, nod along, and say, that's good to know, and then do nothing. And next year at this time, you may still be missing opportunities to reduce unnecessary taxes. Or you can invest 30 minutes, book a consultation, and find out what this could be costing you and what your options may look like. Let's take the next step.